Hello, my name is Tracy VanDell, and today I am going to provide you with a presentation on what you need to know about creating and obtaining a mortgage in today's environment. And here is my audience. It is said that purchasing a home will be the greatest investment a person will make in their lifetime. Knowing the lending requirements and regulations will allow you to feel prepared and knowledgeable as you muddle your way through the laws of 2014 and beyond. But first, we need to understand what caused us to be where we are today. On June 5th, 1995, President Clinton spoke in the East Room of the White House in regards to his home ownership initiative. His goal was to boost home ownership in the United States 67.5% by the year 2000. His quote was, "Government will make home ownership more accessible and affordable for more Americans, allowing everybody to get into their home." That same year, the Clinton administration changed the laws governing Fannie Mae, Freddie Mac, and Ginnie Mae by creating the Community Reinvestment Act. The Community Reinvestment Act. These changes empowered community organizations to pressure banks to increase lending activities in poorer neighborhoods, increase lending to low-income families, thereby creatively financing for people in these markets. The changes that took place allowed banks to lend to higher-risk customers and relax lending standards, as the banks were guaranteed that Fannie Mae, Freddie Mac, and Ginnie Mae would purchase these loans, thereby freeing up the banks to have more money to lend to more individuals. For example, I purchased my first home in 2002. I utilized a government-backed down payment assistance program that virtually allowed the seller to contribute my down payment. On the day of my closing, I was negative $500 in my bank account. However, since I wasn't providing the down payment and the seller was, did not have to provide bank statements to my lender, so they had no idea that I had no money to buy groceries that day. Luckily for me, I was still able to afford my home and make my payments. I sold that house in 2 years after purchasing it with a 64% profit on my first house. In a stable housing market, a home's value should only increase 2 to 3% per year. In 2 years, I had a profit of 64%. As you can see, the bubble was in full swing and the bubble was getting ready to pop. Financing was loose, allowing for no documentation. You had people that worked at McDonald's stating that they made $100,000 a year, and they were able to purchase a $300,000 home. This obviously was going to create problems when they realized they could not afford their mortgage payment. Virtually most lending was structured by your credit score. If you didn't pay your bills on time, you didn't have a great credit score, but that was okay, because then you could just pay a higher interest rate and still obtain a mortgage. Most people on these loans did what was called an adjustable rate mortgage, but as long as home prices were increasing and interest rates were stable, you could spend a year fixing your credit and a year later refinancing your loan and taking out the equity in your house to fix up your kitchen. From 2006 to 2008, as the bubble burst and the beginnings of course correcting began, the foreclosures were on the rise. The government stepped back in to ensure this would not happen again, and on July 21st, 2010, the Dodd-Frank changes took effect. What happens now is the mortgage reform and anti-predatory lending requirements. Many of these changes have taken effect over the course of the last 4 years and will continue for the next 1 to 2 years. What does this mean for you, the borrower, trying to obtain financing today? There is a new facilitator watching over lenders, the Consumer Financial Protection Bureau. In January of 2013, the CFPB sent over 800 pages of rules to lenders on what the requirements were going to be as people take out mortgages today. These rules took effect on January 20th, 2014, with more rules to follow in 2015. Essentially, what this means for today's borrowers is they need to be prepared to supply documentation which allows for a mortgage which allows them to determine that you can afford your mortgage. From the date of your application, you have 7 to 10 business days to determine that you want to proceed with your loan. Once you have signed your intent to proceed for the mortgage, it is time to think documentation. At a minimum, you will need to supply 30 days worth of pay stubs, 2 years of W-2s, 2 years of federal and personal tax returns, and potentially business if you have any ownership interest in a business, 2 months of bank statements, and quarterly statements for retirement accounts, as you will have to prove that you have 2 to 6 months of reserves in the bank the day that you close. So you cannot have a negative balance in your bank account when you buy a house. You will have to provide letters of explanation on address discrepancies, credit inquiries, income fluctuations. You'll have to provide divorce decrees. You will receive an appraisal, and you will be allowed to review your appraisal for up to 3 days before you could sign any loan closing documents. Any changes to fees will also require a 3-day waiting period, so there were no more days where you would go to your closing and your fees increase 2%. That cannot happen to you anymore. It would appear that we have gone from one extreme to another in regards to rules, regulations, and documentations. However, as a consumer, these rules are enforced to protect you, to prevent you from purchasing a home you cannot afford. And by doing this, outside of an unexpected job loss, illness, or death in your family, you should be able to live in your home for many years to come. Thank you for your time. Do we have any questions?
I'd like to know, can you borrow money from your parents?
You cannot borrow money for closing. However, your parents can gift you money, and there is a form that you sign that states you do not have to pay the money back.
How do you arrive at an appraised value?
Appraised value is determined by the value of the homes in the immediate area. An appraiser looks 1 mile within your neighborhood. They do not know the purchase price. They do not know the value that they're trying to obtain. And it is an independent evaluation based on homes in an area that are selling.
How does it prevent another mortgage meltdown?
These new rules and regulations prevent a mortgage meltdown because they allow the lender to qualify you for the loan. You can no longer purchase a home at a 55% debt-to-income ratio, meaning your income divided by what your monthly obligations are. You are capped at 45%. And if you go over that, well, you either need to put more money down to have a lower loan amount, or you need to look at buying a smaller house. Any other questions or answers? Well, thank you. I want to thank you for your time to be present in my presentation today, and I hope you have a nice day.